gold is something that's going to go into other G7 countries. And I think you're going to see more and more of that, which puts another floor, a higher floor underneath it. Physical gold is in short supply right now because people actually want their gold. There's a lot of deglobalization manifesting with the fight over good collateral, and that's gold. I'm long gold genetically. I'm long silver speculatively, and I just closed the platinum long. So I think I have a good handle on what's going on right now, and I won't be surprised if gold's trading here 3 months from now on the way to 3,700.
Gold is on track for its second consecutive weekly loss, as optimism around global trade talks and stronger U.S. consumer sentiment has reduced demand for traditional safe haven assets. Despite this short-term pressure, fund manager Vince Lanci remains bullish on gold's long-term trajectory. While expecting limited price movement in the coming months, Lanci projects gold could eventually reach $3,700. His strategy focuses on holding steady with gold, remaining opportunistic with silver, and staying sidelined with platinum. Even with recent pullbacks, gold is still up nearly 25% for the year and remains more than $220 below its April record high. Continued support comes from strong central bank buying and growing expectations that the Federal Reserve will return to monetary easing. Meanwhile, the quiet repatriation campaign that began over a decade ago in Germany has evolved into a broader global reassessment of sovereign gold holdings. What started with Russia in the wake of 2014 sanctions and expanded to China has now reached Western countries, including the United States. Between 2013 and 2017, Germany repatriated 300 tons of gold from the Federal Reserve Bank of New York and 374 tons from the Banque de France back to Frankfurt, marking one of the most significant sovereign physical gold transfers since the end of the Bretton Woods system in 1971. The U.S. officially claims to hold over 4,500 tons of gold at Fort Knox, yet the last full independent audit dates back to 1953, with only a partial inspection conducted in 2017. This lack of transparency is fueling scrutiny, particularly among lawmakers in countries such as Germany and Austria. According to Lanci, the growing push for repatriation reflects mounting mistrust in the current system and a rising emphasis on physical gold possession. As more nations demand their metal be returned home, the strain on available physical supply becomes more apparent, tightening the market and raising the price floor for gold. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think gold has had a run starting in December 23, but getting going in March 24. And the market is repricing gold for multiple reasons, but the primary reason is central banks have become buyers looking to de-dollarize their assets. And the de-dollarization, while it has been going on for a while, will continue to go on until they get about 30% of their assets into gold as a hedge against the growing influence of the BRICS, as a hedge against geopolitical risk, and as a return to a more mercantilist type of world where globalization just goes away. And I know that you're seeing that in Europe, and we're seeing it from afar, but we're also seeing it. So gold's not going to have any natural selling or swoons lower until the geopolitical, the trade issues all get resolved with a little more finality. Basel III is European in design as influenced by American regulators. Basel III's main purpose is to make banks more liquid, to guarantee their liquidity, and to assure that there'll be no more failures. In the U.S., that centers a lot around Treasury liquidity. And you'll notice, just before we get to gold, that yesterday, the U.S. changed the SLR rules, liquidity rules, making it easier for U.S. banks to be liquid. So basically, they lowered their reserve requirements. Now, gold is a small piece of the Basel III situation, but it's incredibly important, and it is the focus of my world. Now, there's the conventional wisdom is, I'm going to lay it out for you. Basel III has made gold a tier 1 capital, which means it can be fully used on a bank's balance sheet, thereby making them more liquid, making them able to not have any solvency problems. And that's one of the drivers behind gold going up. Does it mean that gold's going to be used as collateral in deals? No. And this is, Basel III is bullish for gold, and that's been in the market. That ship has sailed. That's been in the market for over a year. But now going forward, we're now at a line of demarcation where not only is it not a big deal for gold based on some other things, that I'm basically a little bit ahead of the curve on this, I think. But Europe and the US have agreed to not implement Basel III as they said they had. So that's going to be kicked down the road as well. So some of your listeners may remember during the Grexit crisis, Basel III was supposed to be launched after Grexit, and it didn't happen because the banks were insolvent. Now Europe has made some statements. The ECB made a statement that we're going to delay our own rollout of Basel III funding requirement rules because we're not so sure that we're on the same page with the U.S. The U.S. may not be ready to. And I went, well, then they're just going to kick the whole thing down the road again. So I'm not saying it's a nothing burger. I'm saying that to your audience, Basel III as a driver, a bullish driver of gold is already in the market. So going forward, that makes gold a tier one asset, which means in the past, I have a bar of gold. I need to get some capital. I show it to the Fed or the ECB, and I say, what can I get for this $1,000 of gold? And they say, well, we'll give you $500. You're like, well, shit, I'll just go and sell it and get the $1,000, right? And that's why gold always tumbled eventually. Now it's like I have a bar of gold. It's worth $1,000 or $3,000, $3,300. And I go to the window and I go, how much can I get for this? And the Fed says, $3,300. Great, I don't have to sell it. So there's less organic selling from central banks in panic. And so that will raise the floor continually for gold for years. However, tier one capital does not allow them to go out and trade it more. It just allows them to have a piggy bank that they'll never, ever crack anymore. So gold will rise as a result of that, but only if the powers that be let it be implemented. So the definitive answer for Basel III is it's bullish for gold. It's already in the market. And now the risk is that it gets delayed in implementation again, which would be short-term bearish for gold. That's the bottom line. One of the manifestations that I think you can see over the last year and a half was it manifested in multiple ways, but it all comes down to this. There were too many future shorts against not enough gold collateral. So you had it's fractional reserve banking at the bullion side, right? And this is going to dovetail into the repatriation and the LBMA crisis. So you're funneling this right to where it's going to go. Basel III said, we do not want you, the government saying to the banks, we do not want you to have paper gold longs. We want you to have physical gold longs without any shorts hedged against it. And the banks started to do that. And in doing that, simultaneously, China said, you know what? We don't want treasuries. We want gold. And so all the collateral in the world, the gold all over the place, the global gold that was oversubscribed to, you have a bar of gold, I'm going to short it, he's going to short it, he's going to short it, trillions of dollars tied to billions of dollars. Well, those shorts got unwound over the last 3 years. And so you've seen gradually the open interest on the Comex shrink and shrink and shrink as shorts kept getting slowly and gradually squeezed. So the first manifestation happened over the last year and a half. And that was the futures volume, the futures open interest shrinking as shorts started having to cover. I call it like this. It's a game of musical chairs, and the chairs are the physical gold. And every time someone says, I want this chair, you can't get a seat to park your shorts in. And so it became a scramble. And that scramble peaked with the LBMA kind of getting, I can't believe it, but they were blindsided. You had the LBMA, right, saying, we have all the gold in the world. And then the US saying, fine, we want ours back, whoever it was. And we take it back. And they're like, well, we don't have it ready. Can you give us 90 days? And so there were too many. Look, it's like a scene from It's a Wonderful Life where there's a bank run. It was a bullion bank run, which brings us to the repatriation concept. It started with China. It started with Russia, actually, after 2014. Then it went to China. And now Western countries, specifically the U.S., say we want our gold back. Now, mind you, that's because the U.S. probably didn't have all the gold it was supposed to have to begin with. But now that fever is spreading. And so the repatriation of gold is something that's going to go into other G7 countries. And I think you're going to see more and more of that, which puts another floor, a higher floor underneath it. Physical gold is in short supply right now because people actually want their gold. It's almost like you're in a schoolyard and recess is over and everyone's taking their ball and going home. It's like, where you have my ball, give me it back. And so there's a lot of deglobalization manifesting with the fight over good collateral, and that's gold.
Vince Lanci is saying that while the fundamental reasons to own gold, like de-dollarization and geopolitical risk, are still valid, the urgency to buy gold has decreased. The global fear that previously drove demand is easing. Geopolitics, including wars and international tensions, have been the primary reason behind gold's recent strength. However, Lanci believes that this influence is fading. As conflicts de-escalate and diplomatic progress is made, the urgency to buy gold as a geopolitical hedge is diminishing. Even central banks, though still buying gold, have lowered their bid prices, indicating less aggressive accumulation in the short term. The long-term case for gold remains intact, but immediate buying pressure has softened due to easing trade tensions, reduced war fears, and more strategic geopolitical positioning. As a result, gold may stay range-bound for now. Lanci expects that governments will tolerate inflation to fund rebuilding, shifting the narrative back toward macroeconomic, not geopolitical factors that support higher gold prices. Let's get back to the interview.
The urgency of buying gold is being pulled out of the market. So the fundamentals, which means that the dollarization of the world is not going away, but the urgency to do that and the fear is subsiding. Just to paraphrase something Goldman Sachs had said, the genie from confiscating Russian wealth after the 22 invasion of Ukraine is not something that can be put back in the bottle. And not being able to do that, once we've done it to them, we could do it to everyone. And so at that point, you have a geopolitical, reason to not own gold. Then you have the BRICS, which is also geopolitical, but it's trade related. And they're saying, we don't want to use dollars. We don't trust dollars for different reasons. And we want to own gold. And the BRICS partners, China is the BRICS when I think of the BRICS. But the thing that really got us going, to your point, was the kinetic aspect of the wars that we're having, kind of like a fragmented world war. There's an Eastern Front in Israel, and there's a Western Front in the Ukraine now. But the urgency has backed off, and it's backed off because I think we're at peak tariff, right? We're at peak tariff, knock on wood. Trump is behind the scenes cobbling a Plaza 2.0 type of deal to weaken the dollar. And to the main point is it seems that while he's doing that, for whatever reason, there's a little bit of peace breaking out in the war-torn parts of the world. Note that Trump went to Riyadh and cut a deal with the Saudis, and then he went to China and cut a deal for rare earths, and then Israel attacked Iran. And it's almost like it was a geopolitical tie-in. We're going to work on the trade. We're going to keep the Saudis on board as an investor in the U.S. We're going to hopefully slow them from de-dollarizing their oil sales, and then we're going to kind of let Israel off the leash. And Israel's off the leash, and now it's not just the U.S. protecting the Middle East from Iran or protecting Israel from Iran. You're also protecting Iran from Israel, and I think that's why you're having this escalation to de-escalate. And I thought that's what I called it the first night it happened, and I saw it happening. And those are reasons to not own gold anymore. I think there are reasons to not own gold, and they're based on a cooling of the tariff rhetoric anyway, progressive movement towards the war ending in the Middle East. I'm not sure about the Ukraine-German situation, the Ukraine-Russian situation. I know Germany's right on the for that. If you're Poland or Germany, you're looking at that going, we don't really want to have to deal with this again. And then I look at the central bank situation where they're buying it. And so everyone is basically still buying, but they've lowered their bids. And that's made all the speculators who front run the fundamental buying sell off. So, that might not be too helpful, but I'm just trying to touch all the bases before we get specific. The current events is the geopolitics, right? I think the current event is the geopolitics. The upcoming events are Basel III. And I think the in the wings waiting to become a problem is the gold repatriation concerns that are rising in Europe, and some for good reasons, some perhaps not for good reasons. But if you're asking me to decide, I recently put out a post, a couple of days ago I put out a post, and I said this: geopolitics will not be the upside driver for gold for the rest of the year. The upside driver for gold for the rest of the year will be if it comes U.S. rate cuts. I don't know that it's going to continue. I don't know that Powell's going to do that, but I do believe that as the geopolitical situation eases, the gold bids will lower and be more patient. And as that happens, you're going to have people starting to get short and sell precious metals again because it's no longer a geopolitical hedge. You may have up to $500 in that market. But here's the thing: no one wants to sell it because as we come out of these wars, Europe has been cutting rates constantly. The Swiss are going ZERP and possibly NERP. Is it NERP? I know some of the bonds are negative over there already. And you're looking at a need to respend and rebuild in Ukraine and Israel and Gaza and Iran. And even though those things are inflationary as a gold bug, I think people are going to say we'll stomach the inflation and we'll spend the money anyway. And so the macroeconomic drivers of gold will take the front seat for gold going higher, while the geopolitical drivers are working against gold. So that's broadly how I'm looking at it. Let's make all the geopolitics go away. You ready? Trump has a conversation with Putin, and he says, we're going to give you your money back, right? That's an unconfiscation of wealth. Russia also pulls out of Ukraine completely, right? The unrealistic version. And in the Middle East, Iran completely goes back to, not goes back to, not if they ever were, is completely transparent about their nuclear program and asks for aid from the West in return for transparency. If those things happen, well, it's not going to stop de-dollarization. It's going to slow it. What could happen to gold? To give you like an idea, you referenced the beginning of the Israel-Gaza problem, which was October 7th. And that was an incredibly important date because after that happened, we had a series of different problems that kept taking gold higher. So you had the just going back 1 second chronologically, gold peaked during the invasion of Ukraine. And then it was driven lower by the US Fed finally raising rates to fight inflation. And then it had a trough and October 7th started and it took off again. So now let's take away that. Let's pretend it never happened. You still have, this is the macro part, you still have between October 7th and now, you had banking crisis in the US, SVB went under, right? So you have the fear of banking being insolvent. And I believe many banks in Europe are insolvent. They may be liquid, but they're not solvent. So that's not going to go away. That's a macro issue. You have the deficit problem. As the rest of the world is adding deficit now, Europe needs to rebuild, Japan needs to add to their defenses. Everyone needs to spend money because America's not spending as much money, depending on how you look at it. The US has to go more frugal, or our deficit's going to be a global problem. And we're not going more frugal. I don't care what Trump says or what he's trying to do. It's not going to make a dent. And we're going to monetize our debt and it'll get worse. So between October 7th, 2023 and now, you had maybe 5 events that added $200 to gold. So that's $1,000. Take 3 of them away and gold tops $500. But I don't see it happening. And that's because, and this is the key for me tactically, the bullion banks got obliterated playing from the short side. And that chicken came home to roost, so to speak, when the U.S. repatriated a lot of its own gold. So I don't see more than $350 to the downside in gold. The upside, I think, is also quite limited. Not quite limited, but limited. I think $3,700 by the end of the year is not unrealistic, but I don't think it will happen in the powerful, exciting way that it has. Those are my targets, if you want to call it that.
Momentum in the gold market appears to be entering a transitional phase, where short-term optimism and diplomatic progress are tempering urgency, even as long-range tailwinds remain intact. While investor appetite may be cooling in the face of easing global tensions, more profound structural shifts, such as the re-evaluation of sovereign gold storage and the gradual shift in monetary policy, signal a foundation still being laid for future strength. Quiet moves behind the scenes, such as repatriation efforts and strategic accumulation, hint at a larger narrative unfolding beneath the market's calm surface. The real story may not be in today's headlines, but in tomorrow's revaluation of trust, currency, and reserves. Are current price lulls simply the calm before a broader monetary reset forces gold back into the global spotlight? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.